Are you thinking about buying a home but don't exactly have all the money that you need? Well, don't worry because you've come to the right place. My name is Kay, giving you the keys to home ownership. And in today's video, I'm going to give you a breakdown of the answer to your problem, and that's home loans. Let's get into it. To start off, let me explain to you what a home loan is, or you might otherwise hear it called a mortgage. All that is money that you borrow from a lender to buy your home. And this money has to be paid back over time with interest or plus interest. And that's just the money that the profit that the lender is making based off of the money that you borrowed. Think of it like a long-term rental agreement that you have with a landlord. Instead, you're not paying a landlord, but you're paying a bank. And at the end of it, you'll get a property or a house in return because you'll fully own it. The next thing that I want you to know is your mortgage is repaid with a PITI payment or a PITI payment. And all that is your principal, interest, taxes, and insurance. Your principal is the loan amount or the amount of money that you borrowed from your lender. The interest is the cost of you borrowing that money, which I said, remember, it goes to the bank. The taxes are just your property taxes. And then the last I is your insurance. Now, this is your homeowner's insurance or whatever insurance that you acquired to buy the home that you're looking to buy. So in some cases, homes are in flood areas, or homes are in tornado alleys, or homes are in places where a lot of natural disasters may happen. And the lender may require the buyer to obtain flood insurance, windstorm insurance, and homeowner's insurance. And within the payment, all three of those insurance will be encompassed in the insurance part of your payment. I also want you to remember that the first P&I, your principal and interest, are fixed. So those amounts won't change for the lifetime of your loan. However, the T&I, the taxes and insurance, are not fixed, meaning they can fluctuate over the lifetime of your loan. So if your monthly payment goes up, or if you're lucky and it goes down, that change should be reflected in the taxes and the insurance, which you can see because most times when you buy a home, the taxes and insurance are going to be escrowed, and you should be able to call your servicer or your lender or whoever and work that out and see where that change is reflected. So now that you understand that, the other item that I want you to be aware of are the type of loans that there are. So there are fixed mortgages, and then you have adjustable rate mortgages. Fixed mortgages, the interest rate is the same for the whole lifetime of the loan. Adjustable rate mortgages, or ARMs, have interest rates that fluctuate over the lifetime of the loan. ARMs are a little bit more difficult to navigate, so more people do go with fixed rate mortgages, but both are really great deals. Just understand what you're doing and do your research, and you should be good to go. Also, another component, the term of your loan, which here in the United States, we have 15-year loans and we have 30-year loans. Of course, 15-year loans are going to be a higher monthly payment, but overall, it'll end up being cheaper. While as a 30-year loan will have a lesser monthly payment, and you may end up paying more in the long run, just depending on, you may pay your loan off in 20 years and end up saving you some money on interest that way. But the basic 30-year loan, if you pay it off in 30 years and pay like you're supposed to, no extra payments, not missing any payments, you'll end up paying more in the long run than with a 50-year long term. So just pick long terms based on your budget and what you can handle, and you should be good to go there as well. Now that you know the components of the loan, the long term, we talked about interest, principal, taxes, and insurance, all those good things. Now let's get down to the nitty gritty and talk about the loan options that are out there for you. So there are 4 main loan types. You have conventional, FHA, VA, and USDA. To start with conventional, that loan requires anywhere from a 3 to 20% down payment and does require you to have a minimum of a 620 credit score or higher. Thanks to Freddie Mae and Fannie Mac, which are government-sponsored enterprises whose job is to make sure that the mortgage market is stable and healthy, we have loans like Home Possible and Home Ready, which are for my first-time home buyers wanting to go the conventional route. And this will allow you to get into a home with as little as 3% down. Those programs were put in place for, like I said, my first-time home buyers who may not have a whole lot of money to put down up front, but are still wanting to get on that housing ladder. So those options are available if you qualify. And to touch on the debt to income ratio for conventional loans, it's not as lenient as a FHA loan, but it's not as strict as a USDA loan. Moving on to FHA loans, that requires as little as a 3.5% down payment, and they want you to have a minimum credit score of 580 or higher. This program will also allow you to get into a home with a credit score lower than 580. I believe you can go down to 500 and possibly get into a home, but just know that your down payment will be a little higher. They require you to put, I believe it's 10% down if your credit scores are lower than a 580. But this program is usually where most of my first-time home buyers go, just because they allow you to have a higher debt to income ratio. So this is probably going to be the program that has the most lenient debt to income ratio and will let you go a little higher, like I said, to get you in the door, because this program, it wasn't designed for first-time home buyers, but that's why a lot of my first-time home buyers go here. Moving on to VA loans. These loans don't require any down payment and they don't have a minimum credit score. This is for veterans, active military, or even surviving spouses who meet the requirements needed to get this loan. And then lastly, there are USDA loans, which also don't require a down payment. It's 100% financing, but they do require you to have a credit score of at least a 620 or higher. And these loans are for my people out in the country and rural areas in certain cities whose population may not be to a certain point. If you didn't know, there can be a heavy populated area, like I'm in San Antonio. Certain parts of San Antonio are still rural areas where USDA loans can be used. The only thing is the debt to income requirements are a little on the stricter side. This is probably the loan that has the strictest debt to income ratio, where they don't let you go as high. But if you can qualify, it's really a great program. And just to take a minute, I know I've mentioned debt to income ratio a lot in this video, or you may see it also as DTI. In my next video, I'm going to detail how, if I myself was going to buy a home, would calculate my debt to income ratio. Therefore, I could be more prepared when shopping for lenders, or even when knowing what I can afford when I start looking for homes. And then you guys can use that as a guide for yourselves and what to do. Also, on that note, I don't want you to think that you have to remember everything that I've said in this video. I've actually put together a free guide for you guys. It's in the link in the description below. You can download it, use it at your discretion, use it whenever you're ready to start shopping for your home. Moving on. The last point that I want to touch on are pre-approvals versus pre-qualifications. Now, you may have never heard of those terms, but when you start shopping for homes, this is something, or these are terms that you will likely hear. So here's the deal. A pre-qualification is an estimate of what you can afford based on what you've told your lender, that your finances are, how much you make, how much total debt you have, how much money you have saved, and things like that. While a pre-approval, which is really what you want, is a thorough review of your credit, income, and debt. And a pre-approval is so important when going to shop for a home, because this shows sellers that you're serious. They know you've been pre-approved. More than likely, that means you can qualify for the home that you're shopping for. And the sellers are like, okay, if we sell you this home, we're going to get our money. And then most importantly, it gives you a peace of mind when you're going to shop, because you know how much you can afford. If you're initially, before you get a pre-approval, you're going to look at $400,000 houses, but then you get your pre-approval for $320 and you're putting in offers and they're not getting accepted, that can be discouraging. But if you come in, you're like, okay, I can afford $320. You go look at $320,000 houses. You submit your offer with your pre-approval. More than likely, you'll have a better outcome than as compared to shopping without one. So that's all I had for you guys today. If you are ready to buy, I want you to check out the next video that I have that will be detailing how to calculate your debt to income ratio. Need more time? No problem. Check out some of the other videos I have on the channel to help you guys out along the way. And if you have any questions, please leave it in the comment section below and I'll get back to you. See you on the next one.